All right, today we are diving into one of the biggest questions in economics, one that really shapes everything, from how you save your money to how we deal with the future of our planet.
You know the feeling, right? It's that classic dilemma. Should you enjoy the satisfaction of spending your money right now, or should you put it away, invest it for some bigger reward down the line? Well, it turns out this isn't just about your personal finances. This exact question is at the absolute heart of our biggest challenges as a society.
I mean, just think about it on a much larger scale. A company has to decide, do we spend big on new, efficient machines that will pay off in the long run? A farmer has to weigh getting a big harvest today against preserving the soil so it's still fertile in 20 years. A whole city might have to decide, do we use up our groundwater now or do we conserve it for future generations? You see, they're all just different flavors of the very same problem, the present versus the future.
Okay, so how on earth does economics even begin to wrap its head around something this huge? Well, it all starts with a simple but pretty radical idea. Instead of seeing time as this messy, complicating thing, economists decided to just treat it like any other feature of a product.
This is the big aha moment. What if an apple you can eat right now isn't the same thing as the promise of an apple 1 year from now? What if they are fundamentally different goods with totally different values? Once you start thinking that way, all the standard tools of economics can suddenly be used to analyze choices across time.
And this gives us a formal name for it, a dated commodity. It's a super simple but powerful concept. It just means a good is defined by when it's available, not just what it is. And just like that, an apple today and an apple next year become two distinct products that you can trade.
You can really see the genius of this leap right here. Standard economics is usually static. It's about how we trade, say, apples for oranges right now. But this new approach, intertemporal economics, takes a dynamic problem, trading apples today for apples tomorrow, and cleverly turns it into a static one that we already know how to solve.
All right, so if we're treating today's apple and tomorrow's apple as different things, well, what's the exchange rate? How do we figure out the right price and find that perfect balance between now and later? This is where things get really cool.
It all comes down to finding that perfect sweet spot. This is the core logic of something called the Euler equation. You've hit the ideal balance when you're kind of indifferent about your next dollar. That little bit of extra happiness you'd get from spending it today is perfectly balanced against the happiness you expect to get from investing it and spending it in the future. Let's really look at what's happening at the margin with that very next dollar. If you spend it today, the benefit is instant gratification, right? But the cost is what you're giving up in the future. And if you save it, it's the complete opposite. The goal is to get to a point where those costs and benefits are perfectly matched. So what's pulling the levers on this decision? It really boils down to two main things. First, there's the market's price for being patient. That's the interest rate. A higher interest rate makes saving way more appealing. And second, there's your personal price, which is just how patient you are as a person. Economists call this beta. Let's talk about beta, because it's basically your personal patience score. If you have a high beta, you're pretty patient. The future really matters to you, and you're willing to wait. But if you have a low beta, you're more of a live-for-the-moment person. You want that gratification right now. And believe me, this one little variable drives a huge amount of economic behavior. Okay, but this trading between today and tomorrow, it's not just some abstract idea on a spreadsheet, right? There's a real physical way we actually move resources and wealth through time. That engine, the thing that makes it all possible, is capital. Yeah, it's not magic. We don't just snap our fingers and get future apples. We create them. We do it by taking some of our resources today and turning them into capital. Things like factories, machines, roads, and bridges. That capital is what makes us more productive and wealthier tomorrow. And what this does is kick off this incredible cycle of growth. So an economy produces a bunch of stuff. We consume some of it for our immediate needs and wants, but whatever is left over, our savings, gets invested as new capital. That new capital then makes us even more productive, so we can produce even more stuff next year, and the whole cycle just keeps on going.
But, and this is the crucial part, this brings us right back to where we started. There's no such thing as a free lunch. The steel and concrete used to build a new factory can't also be used to build a new shopping mall. So to get more capital, and therefore have more to consume in the future, we as a society have to give up some consumption today.
So this whole model works great. If you imagine society as like one person who lives forever and makes all the decisions. But of course, that's not how the world works, is it? In reality, we have generations. People are born, they work, they save, they retire, and they pass away. And this adds a really fascinating wrinkle to the whole story.
And that brings us to what are called overlapping generations models, or OLG for short. At any given moment, you have different generations living side by side. You've got some folks who are in their prime working years saving for the future, and others who are retired and are now spending down those savings. And as you can imagine, this completely changes the incentives for everyone.
And here is the absolute key takeaway from this model. Unlike our immortal planner, no single person in an OLG world is thinking about the very long term. My planning horizon is basically my lifetime, right? I'm not really factoring in what happens 100 years after I'm gone, and this can lead to some really surprising and sometimes inefficient results.
Which leads to a question that honestly sounds a little crazy at first. Can a society actually save too much? I mean, we're always told to save more, save more, save more, right? Well, in this Copacabana world, the answer is kind of shocking.
The answer is yes. Absolutely. It is totally possible for an economy to become dynamically inefficient. This is a wild idea, but it can happen when generations just keep saving and building up capital, so much capital that the returns on it get super low. They've basically saved so much that every generation would have been better off if they had just consumed a little more and saved a little less in the past.
Okay, that was a lot of theory, I know. But it's not just an academic exercise. This entire way of thinking about dated commodities and balancing the present and future, it's absolutely critical because it gives us the toolkit to handle some of the biggest challenges we're facing right now. Let's start with the big one, climate change. The real damage from our emissions is going to be felt decades from now, but the costs of cutting those emissions have to be paid today. This framework is precisely what policymakers use to calculate the social cost of carbon, turning those distant future damages into a concrete dollar amount today to guide our decisions. Or how about conservation? Things like protecting our natural resources. How much money should we actually spend right now to protect a forest, or to make sure our soil stays healthy, or to conserve our groundwater? By putting a value on those future benefits, we can make smart, rational choices instead of just making a wild guess.
And this framework even sheds light on something as complex as poverty. Think about it. When people can't get loans, they're essentially locked out of this market for dated commodities. They can't trade their future potential for resources they need right now. And that can trap them because it stops them from making those really smart long-term investments, like getting an education or starting a small business that could pull them out of poverty for good. So when you boil it all down, this way of thinking gives us a powerful, rational way to think about the trade-offs between now and later. We have the tools. The real question is, what price are we choosing to put on the future? Thanks for joining me.